Fair value gaps. They appear on the chart many times and can give you a huge advantage when it comes to trading. Some of them work really well, and as you can see here, some of them don't. But what if I tell you that there is a way to determine whether this fair value gap will work or not? Before we start, please keep in mind that this video is not a financial advice. I'm not a financial advisor. This is for education only. So let's start with the basics. What is a fair value gap? In trading, a fair value gap is a price range where price moved significantly up or down. This typically happens when there is a sudden price movement, leaving a gap between the first candle's low and the third candle's high, or in reverse in a bullish scenario. A fair value gap can help you tell where the price is likely to go next, because in such situations there are sellers, many sellers, and buyers were not even able to push the price up because it was going down like crazy. And what buyers will do is try to trade the price back into that imbalance to rebalance it and then potentially continue moving down. And as you can see, some fair value gaps work really well, but some of them don't. So now we're gonna follow a 5-step tutorial to use fair value gaps to your advantage. So the step number 1 is identifying your fair value gaps. For me, it's a no-brainer, but just to make it clear, you should find something that looks like this: a significant price movement up or down, leaving a gap, a space where the first candle's high and the third candle's low are not overlapping. You can mark that area to make it easier to see and clearer to understand. And as you can see in this example, we have many more fair value gaps. All of them are bullish. Now let's have a look at the bearish example. So when the candle was bullish, we were looking for the first candle's high and the third candle's low. Now it's the exact opposite. So now we are looking for the first candle's low and the third candle's high. And the gap between them is our bearish fair value gap. Can you see how well this one worked here? And also in this case, we can highlight more fair value gaps. The next step of our 7-step process is validating fair value gap. If you ever see price closing below your fair value gap, then this fair value gap is being violated. It's no longer valid. But if the price dives deep into that fair value gap, the wick can even go below the fair value gap, but the body closes inside of it or outside of it, then it makes this fair value gap valid. So in this case, our bullish fair value gap worked as a support for the price. So here we have a clear example of a fair value gap that's not valid. And why is it not valid? Because the price is reaching and testing that fair value gap multiple times. And your another confluence is the price closing below that fair value gap. Once it closed below, it makes this fair value gap invalid. It was suspicious even here, the price touching it multiple times and failing to go above. Okay, but what if I have more than one fair value gap? As we can see here. Here you should anticipate the lowest ones to be the strongest. In a bearish market, the highest fair value gaps are likely to be the strongest. So now let's have a look on this example. We have 2 fair value gaps. Which one of them is the most likely to be valid? Of course, the bottom one. So let's see how this one goes. So the price violates the first fair value gap, but seems to be respecting the next one. As long as the body of the candle is not below the fair value gap, it makes this one valid. And what you can also add to your fair value gaps, if you're using TradingView, you can enter settings and click this checkbox with middle line, the 50% of your fair value gap. This is a strong point, and if you see the bodies closing above that point, it means that this fair value gap is very strong and for sure is valid. The third step of this process is using the equilibrium. You take your Fibonacci tool and drag it from the swing low to swing high, or in reverse when the market is bearish, and as it comes for the settings, you only need the 0, 1 and half. That's all you need. And this shows you where the price is in premium, so it's expensive, and here you are not willing to enter long positions, and in the discount area, so the lower 50% of this whole area, that's where you are looking to open your long positions. So right here we have another beautiful example. So in this case we have 3 fair value gaps on top of each other. In your opinion, which one of these is the strongest? Of course, the lowest ones. But we're gonna add some confluences. We will take our Fibonacci tool and drag it from the bottom to the top. I never use wicks to tell where the premium and discount area is. I use the bodies because they tell the story. Wicks do the damage and usually represent manipulation, but you want to use the bodies of your candles. And which one of these fair value gaps is in a discount area? So the price did come back and respected this fair value gap, not closing below. It violated the first one. Why? Probably because it was in premium. The second one also. Why? Because it was in the premium. But respected the lowest one. Why? Because the lowest are the strongest, or the highest are the strongest when the market is bearish. And this bullish fair value gap was also in a discount area. So if you entered your long position here, you can see that the price moved up significantly, once again taking its previous high. And the fourth step of this process is adding highs and lows as your resistance and support levels. So back to this case once again. What can you see here on the left? That's a swing high. We saw a break of structure, so market moved above this high, breaking this high, moving higher, even higher, higher. And then what we should anticipate for the bullish markets to do is to return to the old highs, and these old highs should work as your support. Insanely good trade, because you have first fair value gap as your first confluence, discount area as your second confluence, and the swing high as your third confluence, because the bullish market is likely to return to this high and this will work as your support. So let's have a look at a bearish example. We have three fair value gaps. So first of all, the highest one is the most likely to be the strongest. And in this case, just by using fair value gaps, you won't be certain. So what should we do now? We should add confluences. The first confluence will be our equilibrium or 50% discount and premium area. If you're looking to enter short positions, you should enter in a premium area, so the upper 50%. So entering your short here is probably a stupid idea, but we need to add more confluences. The last confluence is the latest swing low, which is right here. And why? Because in a bullish market, highs should work as your support, and in the bearish market, your lows should work as your resistance. So we are expecting the price to find resistance somewhere here. So as you can see, the price did move up. And did this fair value gap work? No, it didn't. This shouldn't be taken into consideration at all because it's in the discount area and you are not looking to enter short positions in the discount area, only in the premium. So this one is invalid just right here. So maybe if you entered this trade, because it might seem sensible, right? Because it's a fair value gap in a premium area, so you might enter a short position here. You just got stopped out, and that's normal. Sometimes you lose. We have an area of fair value gap and latest swing low, and this area should work as our resistance. And as you can see, we tested that fair value gap, but the body is closing below the 50%. It makes it quite strong. So now we could enter our short position. We should put our stop loss above this fair value gap or even above this high. Why? Even if we put our stop loss above this high and take profit just close to this low, we still have a great risk-reward ratio. But if this high was much higher, then our risk-reward will be skewed. So then you probably would prefer to place your stop loss somewhere here. And if you were to take this trade live, you should probably take partials like here, here, or here, just to secure your profits. And let's see what happened next. The price did move down and eventually hit our take profit, which was the latest low. So once again, what do we have here? Bearish fair value gap in the premium area. The market is bearish. We are anticipating the price to go lower. It's the third fair value gap of these three, so it's the strongest one. the price is closing below the 50% of this fair value gap. And there is also the latest swing low. And is that enough? No, it's not. Why? Because the fifth step takes into consideration the overall market tendency. So is the market more likely to go up or down? And to know what the tendency is, you should go to your higher time frame, your weekly, your daily, and determine, are we moving up or down? If we are in a bear market, you should always look to enter short positions. And if we are in a bull market, like right now in crypto, you should look to enter long positions. Trend is your friend as long as you can use it properly. Okay, so that's it for this video. If you found this video helpful, then please leave a like below, comment, and if you have any questions, also write them down below. Click the subscribe button, click the notification button so you will be notified when I publish new videos, and see you in the next one. Peace.